This was also an interesting discussion, but maybe let's move on to the actual topic of the day. So thanks a lot, everyone, for joining. Thanks a lot, especially to the panelists who agreed to participate in the discussion, and of course to Nobu for agreeing to give this talk. So Nobu is going to talk about funding horizons, interest rates, and growth. And as usual, there's 1 hour of presentation. Panelists can interrupt at any time and ask questions. Other participants can ask the Q&A, and then I'll monitor and maybe also ask some of these questions. And then we'll also have 15 minutes of more general Q&A after the talk. So Nobu, please take it away.
Yeah. Thank you very much for having me here. And the work with John Moore and Shenxin Zhang. And the question we like to ask is how to finance intangible capital investment. And especially when the continual effort of key workers is essential for developing as well as maintaining this profitable business. So one of the characteristics of intangible capital is the key workers' continual effort is important for maintaining. And particularly if key worker cannot provide the maintenance in future, so they cannot pre-commit to maintain this business, then how that affect the funding horizon? Funding horizon means how much future cash flow the investing agents can pledge and to raise the external funding. So after doing this, and then we try to examine how this funding horizon interact with the aggregate fluctuation and growth. So that's the question we ask. And it's mostly theoretical because of our specialty is more like applied theory. And before going to the formal model, let's try to have the introductory example. This is meant to be a Mickey Mouse example, but try to give some intuitions. So suppose this key worker we call engineer have an investment technology. It's a constant return to scale investment technology. They put the general fund we call goods and also building to construct the plant, production facility. And also through this investment, the engineer gets the human capital for maintaining this plant in future. So the goods and building are input, and the plant and the human capital are output. So, and it's a constant return, this technology. And then in order to finance investment, engineer sell the ownership of the plant to the saver who have money. So you can think of this as external equity funding, or they can basically borrow 100% against the plant. The one which the engineer cannot sell is the human capital. This is based on John's work with Oliver Hart on theory of debt based on inalienability of human capital. Basically, plant you can borrow or sell actually, but the human capital they cannot sell. And if the engineer provide a continual maintenance, the plant yields the return YT plus 1, YT plus 2, YT plus 3, and so on. So continually coming. But once missed the maintenance, the plant stop yielding anything. So this is the example we have. And the key aspect, which is different from usual matching, is the match between engineer and plant owner can change over time. So this period, engineer and owner, plant owner, look at each other. But the next period, the engineer can work for other plant, as well as plant owner can hire other engineers. So it's only one period match. And then engineer cannot pre-commit to provide the maintenance service in future. That's the environment. So what's the bargaining look like? So plant owner and the engineer is currently bilaterally matched. And then the bargain over the reward this period. And so the plant owner's point of view, this is the continuation value and minus the payment to the engineer, wage payment to the engineer. And outside, if they don't maintain, the value disappears. So this is a surplus for the plant owner. While the engineer's point of view, so next period, they can work for somebody else, means the only surplus is this period wage. And typical labor matching model, the continue to match minus the unemployment is the usual surplus. But here, there is no unemployment. They can work for somebody else quickly next period. Therefore, only surplus is the W for the engineer. That's the difference from usual bargaining. Do you see the? And then if you solve this Nash product with the coefficient theta for the plant owner, 1 minus theta for the engineer, you can see the W is the 1 minus theta fraction of the bargaining fraction of continuation value. Theta fraction goes to the plant owner. So if you look at the today's value of the plant, is the output coming today minus the wage payment to the engineer plus the continuation value. But the wage is 1 minus theta fraction of continuation value, means the last two term is the theta over R to the Vt plus 1. So theta fraction retained to the owner, but 1 minus theta fraction eaten by the engineer this period. And so you can iterate this next period and so on. You can see the value of plant to the owner is that today's output goes in owner, but the next period output only theta fraction is going to the owner, and the 2 periods later, theta square fraction, and so on. And if you think about the theta to be less than 1, say 90%, this says the present value of output revenue going to the owner is quickly declining into the future. So therefore, plant value to the owner is largely come from near-term future. So for example, theta is 0.9, theta square is 0.81, and a quarter later, it's like a 0.6 something. And a few years later, it's quickly disappears with discounting as well as the theta business. And so we can say the funding horizon. So owner derives the value mostly from near future revenue. And therefore, when engineers sell the plant to raise the fund to finance investment, funding horizon is not that long. It's not super short, but it's like a 5-year or several years. That's the funding horizon. So, yeah.
Can you explain?
Yeah.
You know, I would have thought that the owner would get a fraction theta of everything, and the agent would get 1 minus theta of everything. But apparently, this is not what happens in your model. In your model, theta is to the square, to the third. Can you explain the intuition?
Intuition is basically every period 1 minus theta of the continuation value goes to the engineer. So engineer is keep biting the 1 minus theta fraction every period. Therefore, more distant future, they have more opportunity to keep the biting. And as a result, the owner gets smaller and smaller fraction of future output.
Yes.
And,
okay.
This is,
thank you.
yeah.
I understand. I think my confusion came from the fact that I was expecting the agent to have 1
theta
minus theta of the output.
No,
but that's not what he has. He has 1 minus theta of the value.
On the value. And then the trick is this bargaining. So you see the owner's point of view, continuation value is a plant value. But the engineer's point of view, it's just the W. And not the continuation value minus outside option. That's why the engineer keep biting. And then next question is...
Sorry, also just following on this, is it correct to interpret it as kind of a reoccurring hold-up problem? That the investor makes an initial investment and then every period...
but I will explain. This one is look like a theta is coming from somewhere from heaven. But I try to explain where the theta come from, what determines the theta. And also, like, is there any other way of mitigating the problem? Like, say, stock option, paying the stock options, or non-competing clause, or a lot of other way. So this is a Mickey Mouse example. So that's the, we just don't have it's like a lot of things are exogenous. But I will tell you, it's not the theta is arbitrarily small. So, okay, Felipe,
so Nobu,
question?
Quick comment / question. So as you highlighted in your opening remarks, the engineer here, there's a lot of lack of substitutability. Engineer is key. To use your word. And so I guess I'm wondering, I absolutely see this as being relevant for a lot of relationships possibly in the economy, but I'm not sure I see it as relevant for all relationships in the economy.
The one thing I would say is engineer is important as a community, but not the particular engineer is important because of they are changing over time. So it's not about the Elon Musk or Bill Gates or that particular unique engineer. It's more like a group of software engineer working for Microsoft or that sort of place. And the group is important to maintain the productivity of Microsoft or Google's. But the key is they can move to the other company. So they can move to the other companies, and therefore they keep asking the contribution. And I will explain because some of your question I can answer better by developing the full model. And I try to put this theta into the production function and to substantiate that kind of questions. Yeah, Felipe, you have questions?
No, perhaps. No, hi. Perhaps like in the model that's going to become a little bit clearer, but so tell me if that's the case. But I guess one thing, to other people's questions that I'm struggling with a little bit is in your work with Mark Kirkler, right? There's also bargaining taking place over the surplus. In which this environment is fundamentally different, or is it kind of looming in there as well, and you're just exploring it now?
So you can right now the only current engineer group has the ability to maintain the business, and so it's bilaterally matched. But the next period, you can hire other engineer, and the engineer can work for somebody else. That's why engineer surplus is just W. But for plant owner, if you miss the maintenance, it's gone. So the stake for the plant owner is the continuation value. So that there is asymmetry between these two groups. And I will explain along the model to substantiate these things. So can you wait for me to develop the model? Okay, so the model is small open economy and the perishable goods, which can be used for investment or consumption. And every agent risk averse with low utility. And some agents have investment opportunity. We call them entrepreneur or engineer. Sometimes they don't have an investment opportunity. We call them saver. So fundamentally, they are symmetric, but the state is different, whether they have investment opportunity or not. And they switch this status according to Markov process. And if the engineer has investment opportunity, engineer E has investment opportunity, they can put the goods and the building to construct the plant, 1 unit of plant. And the initial productivity normalized to be 1. And when they invest, also they get the tool. So engineer will get the tool. This is a human capital, basically acquired to use for maintenance. And this tool, you can think of this learning by doing and usual learning by doing is learning by production, but this is learning by investment, gross investment, which turns out to be the actually same as Ken Arrow's classic paper of learning by doing. He attribute learning by doing by gross investment, not production actually. So we use the Arrow type learning by doing model. So then engineer raise the funds. Can you see the top or you cannot see your, okay. Can you see the top of the screen? So engineer raise fund by yeah.
I mean, I know the answer to this, but maybe it's good for clarification. Who after the engineer works, who appropriates the output of the productive unit and the tools? Who has the ownership?
Ownership is the owner is the plant owner owns the output, but the maintenance is done only by human capital owner, which is engineer. So engineer owns human capital, plant owner owns the production facility. So, and then the way it works is engineer who invest is try to raise external fund and they sell the ownership of the plant. You can think this as an external equity financing. So they borrow money 100% against the plant. And then what the engineer cannot sell is the human capital. So and then match between the plant owner and the engineer is not specific, not even this period. So introductory example, the match between the plant owner and the engineer is bilateral this period. But now I said it's not even this period, not specific. So plant owner can hire engineer for maintenance in competitive market at the wage rate W. This is, and the engineer cannot pre-commit to work for less. And actually, this is similar to Narayana's paper with Cole, Harold Cole on non-exclusivity constraint. So basically, Bruno has a paper too. So basically, you cannot keep track the trading history of engineer. So, and the engineer can trade privately at the market without planner observe it. So this is the same. Basically, the engineer can work at the marketplace, at the market rate, and the engineer cannot pre-commit to work less than market wage. That's the constraint. And so then at each date, owner of the plant of productivity Z, initial productivity is 1, but general productivity Z, hire engineer, 8 unit of tools, and to produce the output. So output is proportional to plant-specific productivity Z and the aggregate productivity A. And the tool is used to maintain the productivity. So here the production function is showing up theta. So today's productivity affects tomorrow's productivity as elasticity theta. And tools, the engineer is affecting tomorrow's productivity with elasticity eta. So that's the maintenance function or production function of the productivity. And every plant will shrink by factor lambda, 1 minus lambda fraction of the plant collapse. And we assume the tool will also collapse. So we choose the tool to plant depreciation rate is the same because it's effectively the investment generate the plant and tool, and the tool is enough to maintain the plant at the productivity, initial productivity. So initial productivity is Z1 and H is 1. Next period productivity is also 1. And the depreciation rate is the same, means the plant to tool ratio is also 1:1. And therefore, it's basically the initial investment is just in producing enough human capital to maintain the productivity at the initial level. And but the heart of the paper is a model, is this production function. So this is actually motivated by Ben Babel, the Austrian guys. Basically, the H will affect tomorrow's productivity. The day after's productivity is affected by the tomorrow's productivity and tomorrow's effort. So eventually, the human capital determines everything. So, but it affects through this roundabout technologies. And the intuition why the engineer get a lot of return in distant future is the future return is mostly determines the cumulative effort of age. The initial impact of Z is shrinking factor theta square and so on. So this production function is a way to substantiate the bargaining power. And instead of bargaining power, we rely on the market and non-exclusivity constraint. This makes sense. Okay. And then concerning building
here Nobu,
yeah.
Maybe it's good to compare the example, first example, and this one. In the first example,
so
you
example is the theta
clear...
and 1 minus theta.
Yep.
And then actually I will show you if eta is 1 minus theta.
Yeah.
Actually, then example and this competitive equilibrium model is the same. Actually,
but they are the same in terms of the, I guess, the
outcome.
evolution of Z, but in terms of efficiency, they are completely different.
Yeah, it's different.
Oh no, I wanted to make that distinction. In the first example,
like your familiar Hosios conditions. If this theta of the maintenance technology, wait, where did I? Sorry, maybe I lost the. Yeah, here. Here. So if the theta and 1 minus theta is here, then and the bargaining power of this guy is theta and 1 minus theta, turns out to be outcome is the same. so this is like a Hosio-like conditions.
But the first one, the optimal wage should be 0, right?
No.
Because there's no marginal dimension. It's like it's always 0, 1. The ideal thing is to the discount factor of
this is a production function, and this is a real model. The first one is just an example. So please think about everything in terms of this technology and non-exclusivity constraint.
Okay.
And then concerning the building, we just assumed the supply by foreigners. Foreigner has the alternative use, the F unit of output comes and the same depreciation rate. And so you can think F as the alternative use and parking lot. And the credit cycle model, actually the F depend upon size. So more insider is using the building, the price is going up. But here we assume the F is constant. So supply price of building is only depend upon interest rate and depreciation rate, not the size itself. And the plant owner now allow the option to knock down the plant to liquidate into the plain vanilla building. So we here assume now allow the plant owner to stop. So they can get the output today, but instead of maintaining, just knock down the building into the sell at the building price, or you choose to maintain by hiring the engineer. And then tomorrow's productivity will depend upon age, how intensively the owner hire the engineer. And in that kind of environment, actually the owner should choose to make the long-term plan. If they choose to continue forever, they will maintain properly. But if they choose to stop in finite time, they don't maintain the day before and or that final date. And so they start declining productivity beforehand.
I'm missing where am I seeing the impact of the non-exclusivity constraint on the
W. W is the competition. So the non-exclusivity constraint means it's like a quid pro quo. So you hire engineer, and the wage is competitive wage, not the contracted wage or contingent on something else.
So what would contracts look like without the non-exclusivity problem?
You can sharing the contract, so like a sharing the total pies, which is like a Bruno's like okay, let's split the pie. Entire output, present value of output, let's split. So that's the the exclusive. Like it's more like a paying by stock option. Here they can sell right away, and even stock option, they can privately sell the stocks to somebody else and then use that money for investment purpose. So that's why it's just W. So
okay. And if W is determined by a market,
yeah.
Is there an inefficiency?
Yeah, I will come back. Yeah. So then the initial plant price is the initial productivity is 1. Therefore, the price when they invest, construct a new plant with productivity 1, the amount they can raise fund is the plant price, brand new plant price. And so budget constraint of engineer is like this. So they can consume and they can invest. Investment cost is the goods cost and the building cost minus the amount they can raise fund by selling the plant. So this is a down payment for investment. Of course, they can save in terms of the financial assets, which includes the plant ownership. So they can retain part of the plant and or internationally traded bond. This is a small open economy, so rate of return for plant ownership and the bond is the same. And then what's the fund come from? It's a human capital's return as well as the saving from last period and the financial assets. And the engineer who have investment opportunity can have a positive I. So then in that case, the H will go up by the human capital or tool will go up. The ownership of the plant is counted as a this financial assets. So it's that bad. So the simple case, actually, they sell entire ownership of the plant. Therefore, only things they retain is the engineer will retain is the human capital. So this is you plug in that guy and then write down as a gross. So this is the consumption. This is the acquisition of new human capital level and financial assets. This is the human capital return, flow return, as well as replacement cost. And one tricky bit is what happens if engineer become non-saver? What happened to that pool? And there we assume you can sell the tool with instruction how to use it. So it's like you can sell the tool to graduate students then with instruction how to use it, and then you can charge the replacement cost. So that makes this budget constraint same. And so the right-hand side is the net worth, basically. And if you have a situation like investment is more the profitable than interest rate, this is the down payment cost for investment, and this is the flow return and the replacement cost. If that return exceeds the interest rate, international interest rate, then engineer will not save in financial assets. They save everything in human capital. And the 1 minus beta fraction they consume with log utility. In the savers case, they don't have an investment opportunity, therefore they consume and save in financial assets. And the competitive equilibrium is basically the two price. One is the competitive wage rate, and the other is the new plant price. And then quantity people choose, which consistent with market clearing. So that's the general equilibrium.
Nobu, so a couple quick questions. So one is, you're always using the language of international economics, but couldn't I interpret this as being a sector in a large economy like the US?
Yeah, you can do that. Yes.
And then my other question is about, I didn't quite follow everything about what happens if the engineers become switch status, but it sounded to me like I wasn't this ability to write instructions, shouldn't that be part of how does that play in the contracting space? I mean, if there's
Contract,
an ability to get graduate students.
yeah. So you can sell this used tool with instruction. So that's the market. And then every market so basically the engineer is very close to anonymous agents actually.
Yeah.
So the only things which rely on is a plant ownership. Plant is reliable. Ownership is well defined. While engineer is fooling around and they can disappear somewhere else. And they can sell the tool privately as well as they can work for somebody else privately. And they are almost like anonymous agents.
I have a silly clarification question.
Yeah.
Isn't R also a price that should be endogenous?
R? This R is the small open economy. so that's why we take it exogenous. So
okay.
yeah. It's closed economy, yes. But the small open economy, it's international interest rate.
But I guess when I'm listening to you, I'm thinking about this as being the tech sector or some
you can say that, but we want to do it aggregate. So we
I'm gonna my interpretation will not work for that experiment, that's for sure.
Yeah. So then okay, so what's the equilibrium look like? This is guess and verify. If alternative use is not as good as some critical level, so the parking lot is not so profitable, actually no plant owner will stop the plant. So then initially the tool to plant ratio is 1:1, and no plant stops, and the depreciation rate is the same. And therefore the plant to tool ratio stays in 1. So H is 1 per plant. So initial productivity is 1, and H is 1, you get the next period, Z prime is 1. And then every plant has a same initial maintained at the initial productivity level, means output is A. And then what I said, Hossio's condition is this one. Basically, if the maintenance technology is constantly done, so if the productivity today is doubled and the maintenance effort is doubled, tomorrow is doubled. If you have such maintenance, the technology, and then competitive equilibrium and bilateral matching model I explained in the introduction is equivalent. So in this sense, the initial example is a special case of the competitive equilibrium. Yes.
Nobu, I'm sorry, I'm lost.
No.
I'm trying to understand.
Yeah.
What is the first best, and what is the friction, and what is the deviation from the first best?
Friction is the entrepreneur cannot sell the tool to it's a human capital. The only way they do is the hiring graduate student and teach how to do it and then do it. So the distortion is not coming from maintenance. Its distortion is coming from investment. So at the time of investment, the entrepreneur cannot invest as much as the social best. And so maintenance-wise, this looks like an optimum, actually. So once it's invested and everything is perfectly fully employed, and so it is, in this sense, it's constraint efficient. But
if there was no friction, would the
productivity can invest more? So the investment, they can raise more fund at the time of investment, and the investment will be higher. So
is that what about the productivity, Z? Would it be the same?
Productivity-wise, probably we didn't solve it honestly completely, but I think this is efficient. So initial productivity is maintained, is efficient. Only scale of investment was not the fast-paced.
Thank you.
And concerning the horizon, so wage is basically the same as the present value of marginal product of H. So H is higher by 1 unit. Tomorrow's productivity is going up by eta. So at that point, evaluating at 1 point, this is the marginal product impact on the next period. But the 2 periods later, GT plus 1 is higher by elasticity eta. That will push up the 2 periods later productivity by eta theta. So this is the impact of today's H on 2 periods later. And 3 periods later is theta square. So the wage is basically partly claimed to the future, tomorrow, but the 2 periods later and 3 periods later. So that's the wage. Wage doesn't mean it's not the same as the like an incentive constraint, like a people put the effort and people wants to put the carrot in future. Wage is constant, but nonetheless, wage is claimed to the future output. And when you look at the plant owner's profit, output minus wage, it's constant. It's nothing declining or anything. But when you look at which fraction of output goes to the plant owner, the more distant fractions, it looks like going down. So the engineer's share of output is rising with horizon, 0, eta to the 1 plus theta, and so on. And the plant owner's share looks like a declining. So this is the horizon. So
Nobu, sorry,
yeah.
I think that last slide was extremely helpful for me, at least.
Yeah.
So that basically, it's sort of like a general capital kind of investment issue.
Yeah.
And if you were to write an optimal contract, these shares would be constant over time.
Yeah.
And it's just the bargaining problem at every period leads them to
it is efficient.
Deviate from that.
Yeah, so this is efficient. Like a marginal wage is according to the marginal product is efficient in this sense.
Yeah.
And then, so the owner's part, therefore, it looked like the owner's share is declining because of theta square and so on. At some point, it's even less than outside option F. So then natural question is, why don't you stop? And the answer is the T to T prime time pass, like a wage you already paid is partly contribution to the future, but you already paid the wage. Therefore, the owner's point of view, it's still the productivity is initial level, and their share is this one. And therefore, it's like a moving target. So always you derive the value, the owner derive the value in near-term revenue, near future revenue, but they don't want to stop because of the past wage you paid between T and T prime is already sunk cost. Even if this one corresponds to the contribution to the engineer of the engineer and the past engineering effort, you already paid. So you already own this productivity. Therefore, the owner doesn't want to stop. And then this is the Yuelan Ma gave us a little bit of supporting evidence. She said the knowledge capital, like higher the the knowledge capital is basically capitalized value of R&D. And then when you look at the knowledge capital share to total capital, and this is the maximum debt to EBITDA ratio in the corporate debt contract. Actually, it's like 3 to 4.5 years. And the larger the share of intangible or knowledge capital, the borrowing constraint gets tighter. So it's like a theta is bigger, smaller, and 1 minus theta is bigger. Maintenance is more important. Then borrowing constraint is tighter. And she also did something design cost share. Similar picture comes out. More intangible, the debt covenant, the upper bound of debt issue is lower. So, but then
I think a sharper piece of evidence would be some kind of something about the borrowing rate, discount rate.
I will show a little bit more.
Okay.
But,
so this is like a
can I ask something?
evidence.
Yeah. I agree with Narayana. I don't know if this evidence is really serving your model. I mean, first of all, it is going to be a very small part of the economy. These are listed firms.
So
it is going to be 26% of aggregate US employment. You are talking about all engineers, and you are going to have policy recommendations. So it is, and it's completely driven by selection, because these guys is going to be, first of all, they are going to be very large borrowers, and that debt is going to move by
that issue.
Other things.
Next one.
I think it will end. Other things than
the
design cost share, intangible capital. Plus, intangible capital firms are going to be, much smaller firms, and they are going to be way more constrained. So I think this figure is just combining A and B, where C is missing. So it's completely by coincidence that it is a negative.
I will come back. So I will show the other evidence, which might be a little more support answering your criticism. But you see the fundraising capacity is owner share is like this. But the building price is a present value of alternative use F. So when you look at it, actually think about the experiment of supplies permanent fall in interest rate. So interest rate drop. So what happens permanently? And the fundraising capacity is medium term, like a 5-year term, while the duration of building is 30 years or longer. So there is a duration gap. So actually the building has a longer duration. Then when you have an unanticipated drop in interest rate, the net worth go up, but and the cost of investment go up a lot because of the Q has a long durations. The building has a long duration, but the fundraising capacity is a medium-term duration, which doesn't go up as quickly as Q. So this case, actually, you might have a situation like despite of lower interest rate, investment eventually go down. So this is the picture. It's like a Shenshin did the sort of impulse response. So impulse is period 5 interest rate go down permanently. And at this point, net worth go up and everybody is happy. And the consumption go up and the output starts going up and the foreign debt also go up. So everybody is euphoria. But the bad news is actually the fundraising capacity failed to catch up with the investment cost. So therefore, eventually investments stagnate. And our model is sort of endogenous growth because of the human capital and the plant is both constant return. And so in this case, you might end up having the lower growth. The consumption starts stagnating and debt, just you have a big debt. And I came from Japan, so late 80s, everybody get excited. Wow, our asset price go up so much, and everybody euphoria. But maybe the investment cost go up more than fundraising capacity, and the real investment to build a plant and accumulate human capital was slowing down. Then you end up getting the lower growth path. And maybe intuitively, like a low interest rate, usually the real estate price go up. And so net worth initially go up. So this is good for old timer. And we emphasize in credit cycle. But the actually newcomers' point of view, maybe their borrowing capacity doesn't catch up with the housing price. So newcomer cannot buy the house. And if newcomer cannot enter into the market, eventually it stagnates. So that's the picture we get. And but then like when I talk to the central banker, they get come on, get serious. Usually reduce interest rate is a stimulating economy, not the stagnating economy. And the answer is that typically central bankers' duration of interest rate is like a 5-year span. So low interest rate for a while, later go up. So if the interest rate fluctuation is like a 5-year style fluctuation, then borrowing capacity does go up a lot, and building doesn't go up as much, and the investment does go up. The danger is the yield curve control, like Japan, like you suppress the interest rate, not just 5-year, but 10 years and even 30 years. Then the investment cost can go up more than borrowing capacity, and the investment can stagnate. So this is the like a danger of the the yield curve control in this sense. So,
but can I
ask you a question regarding the Japan?
I'm sorry, I mean, Japan, yes, I fully agree, but also we have the European case, and I think at this point, central bankers understand very well low interest rate is going to have the potential to kill productivity growth. But the way it works in Europe is actually through the misallocation of resources. I mean, you can match.
Say that's the only mechanism. But
then my question is, because all these curves can be matched when there is the the misallocation of resource, in the sense that low productive guys get the money but they are low productive. So you have okay. And then you have the credit boom, you have the foreign, you match all these actions.
I would say this is not the only story of low interest rate can generate
but my question is this: what is the data moment that we can look to separate your story from the misallocation story?
I will come back to the data questions. And before going, I want to
because
say,
now they're equally good stories. They are equally good stories. There is nothing that will put your model over the other model, unless there's something we can look in the data to separate.
So the one thing I would say is what happens if the alternative use is better? In that case, actually, plant owner is initially indifferent between stopping in finite time or continuing forever. And because of some plant is shutting down, the continuing plant has a higher human capital, more than the maintaining. Therefore, productivity starts increasing for the continuing plant, while stopping plant, productivity declines. So this is actually the endogenous separation. So usually productivity evolution is exogenous, but here it's actually diverging. And productivity is shutting down stuff is going down and this is like a bit different from Hoppenheim style model. The productivity is partly endogenous, partly maybe due to the shocks. Then what you have is a sort of the good plant try to maintain better and improving up to some point. Bad plant is giving up. They start not maintaining well, and the productivity keep going down before shutting down. And so this is a little different from usual the IO literature. And but let's go to the panel data since Shebna asked. So this is so this is actually not our stuff. Actually, the Bank of England economist, the Gabor Pinter, show us this. So basically, what we did is a small business panel data. So then what is the, this is like it's a lot of companies and a lot of small ones. And in fact, it's the entire space of the UK business. And then what we did is looking at the interest rate supplies. And at the time of the monetary policy announcement, so 30 minutes window, plus minus, like a Gertler-Karadi style shocks. And how much it affects the short-term interest rate, how much affect the long-term interest rate, and then how much it's affect to the investment. And the investment-wise, we split the sample. So we didn't have a good measurement of intangible capital because there are a lot of little guys, they don't report the intangible. So what we did is the number of directors relative to number of employees, which is a very crude measure of importance of engineers. And we call it the top-heavy company as a funky. And not so heavy is the non-funky. Actually, this name comes from Pat Kehoe. So what is your funky technologies? And we kind of like funky. So we decided to call this as the top heavy is a funky. So funky group, how much impact to interest rate, short-term interest rate shock versus long-term interest rate shock. And then non-funky, how much effect. So this is a funky dummy. This is a non-funky dummy. And then when you look at it, this is the impact. So funky company, how much impact to short-term interest rate shock, and non-funky companies. And then turns out to be non-funky is not reacting much to the short-term interest rate. And it's eventually negative, but not significant. And the non-funky company does react to the long-term interest rate, which is the usual investment functions. Basically, long-term 5-year interest rate shock, they do react normally. The funky company don't react as much, and the gap is significant, actually. So this is our best evidence. So the long-term interest rate shock affect non-funky companies. But the funky company, horizon is short, they don't react as much. So that, and if anything, funky company react to the short-term interest rate. So that's the suggestive evidence we have so far.
Yeah, very good. Very good. One question, these are not the same regressions, right? Are they are like different regressions you are summarizing results?
So we are doing the funky dummy and non-funky dummy interacting to the interest rate shock. And you might say it's all come from the small business. Yes, a lot of small business. The funky dummy, you have to do like a size controlling. So yeah, that we did. By the policy, so Bruno's questions, like, can you do better than this? And then, so the basic friction is the engineer do not maintain unless paid every period. And this is the non-exclusivity constraint. Basically impossible to keep track the trading history of engineer because of they are almost anonymous. And then, but plant owner, you can chase. Like a plant doesn't run around. So the one possibility is okay. You cannot keep track of the identity of an engineer, but you maybe chase the plant owner, how many engineer they hire. So then they tax the payroll to the, so suppose the government can chase the plant owner, how many maintenance you did and how much they pay to the engineer, and the tax.
Oh, the maintenance here is H?
H, yeah, H per. So the W.
I don't understand. I don't know. I mean, I'm thrown off. I've seen this presentation several times. I mean, there's
So
a
this one
H is
is
a factor, and there's a price for a factor, and any there are no externalities. So
yeah. So this is the payroll tax on engineer. So to the plant owner. So then what happened to the economy is actually the plant owner's total payment is the present value. So this one doesn't change. This is the including the plant owners is going to pay this much for the total. And then if you tax on them, this is the like a total pay pre-tax is so W is a pre-tax wage, and after-tax wage is W to the 1 minus tau. So what happened is the engineer gets less, and the plant owner pays the same amount because of it's comparable to the present value of the marginal product of H. And then what happened is it's like you can use that, government can use this tax revenue to subsidize the initial investment. Then this is a down payment, initial investment, and because they get the subsidy. And effectively, what happened is the government is acting like a social creditor. So they subsidize the engineer for investment, but later they tax the revenue because the plant owner pay W, but the engineer get only 1 minus tau to the W. So if
this is very similar to how you would fix the friction that leads to misallocation. You are taxing the owner. So the larger owners, the top heavy guys, they are going to pay a higher tax, and you are going to subsidize the engineer. So
engineer is subsidized when they are investing.
Exactly.
But when they are
later on,
they are taxed.
Yes. Exactly. So that's what I'm saying. It's the exact same policy if the misallocation is through a financial friction, where the guy who is going to invest doesn't have the credit. You are giving the credit.
We are not chasing the engineer. We are chasing the plant owner. And,
but still, you are going
doesn't conflict with this non-exclusivity constraint. Yeah, Bruno?
Right, but the policy in practice works exactly the same, I believe. Is that correct? Is that correct? It's going to be the same policy?
Not exactly the same in the sense that we are not taxing engineer. We are
I know. No, you are crediting
the plant owner.
This is exactly what I'm saying. You are, yes. Okay, let me speak. So you are taxing the owner. So the larger the owner, you are going to tax even more. You are subsidizing the engineer. So you are giving credit to the engineer.
No. Engineer is not tax. So engineer pays. Yeah, it's actually engineer pays later, and
through the
gets
payroll
subsidy at the beginning. So yeah.
I see. So the owner doesn't pay anything. So you are not taxing the owner at all.
Yeah,
it's different. Okay, all right.
Yeah, it is different.
It's different. Yeah.
Bruno?
So, yes. So here the government is able to do something that the firm owner, the principal, is not able to do. And it's not entirely clear to me why the government is able to do that and not the principal.
So basically the assumption is the government can keep track the payroll of the owner. And while they can force to pay this the tax.
Where I'm completely lost is that age is a factor, and there's a market for that factor.
Yeah.
And I don't see any externality, nor any
change.
contracting constraints.
No, the difference is the wage to the owner doesn't change, but the wage payment received by an engineer will drop by factor how. And so they put the sums on.
No, but before you go to the policy, I want to understand, if I were to write this in a first year, social planner economy, what would be the difference in the allocation, and where's it coming from? There's
the difference is
welfare theorem won't work.
No, investment time, they cannot invest as much. So if the engineer can pre-commit to work less than market wage, and they can raise more fund at the time of investment. And here the government is doing that basically.
It's at the time when it sells the plant, where the friction comes.
They sell the higher price. So they can they sell the same price, but the engineer get paid less. So engineer is getting paid less at the benefit of receiving subsidy today. So it's like a social creditor to the engineer. And so the main point is the engineer cannot pre-commit to work less than market wage. And by doing this taxation, engineer effectively working less than pre-tax wage because of after tax is lower than marginal product. And then the use that tax revenue to subsidize initial investment, you can improve the allocation. But the key is the government can get the record.
I think going forward, I think going forward in the next presentation, you should spend more time on the time zero problem of the engineer selling the plant.
Engineer is
explaining what the credit friction is. Why you wanted this, because like the wage is completely efficient. It's marginal.
But
it's a time zero where he can do something.
That's right. Investment,
and that's where the market is missing, and I think that's where you should spend more time.
Sorry. Bruno, you said.
So like given the formula, why you're not looking at this tax advantage for capital, right? Like, so one of the things, because this policy that you're saying, I don't know how to implement, right? But we do have some tax
of maintenance. So payroll tax for maintenance. So
like we already have something.
You don't tax individual engineer, but you are taxing the payroll payment.
You need to decide how to give the subsidy. Like it's unclear to me how you would, or you're like, because the way I was thinking, like there is a tax subsidy in place to fund depreciation, right? Like when you invest.
A lot of developing countries, like income tax is hard, but the payroll tax is feasible. So this is like a payroll tax for the plant owner.
The tax I get, I'm more concerned about the but like okay, we can do this, but we have in place a capital depreciation kind of subsidy, right? Like we allow the plant owners to depreciate the investment capital in a very which seems kind of very high rate, which kind of works as a subsidy to invest in capital.
No. So maintenance choice, given investment, it is efficient. And so nothing wrong about the maintenance and wage rate, competitive wage rate. What is wrong is at the beginning, the engineer cannot raise enough fund for investment. That's the distortions. And the reason they get is that they cannot commit to work less than market wage.
But if you subsidize the plant
investment.
to buy the plant, it will not help?
No, this is the investment subsidy S. Like then down payment for investment is not the investment cost minus fund raised outside, but also government giving S. so that's why the down payment is lower and the investment will be higher.
Yeah. No, I understand how this work, but I don't want to hold it up. My question is like, if you could do a similar policy that's already in place that subsidize investment by the capital owners. I just want because that we already have a policy for that.
So if you tax the capital owner don't pay much to the initial investment. So that's disaster actually. So S go up, but the B go down, and it's wash out. So you don't want to tax the capital owner. You are taxing the engineer. Like then engineer end up working less later on, and effectively engineer can pre-commit to work less, and that way the owner gets more, and the owner is indifferent. Yeah, Bruno. Wait, quick.
Yeah, just a quick question about the exercise. Is there a kind of concern of elasticity, like taxing this?
Maybe, so the conservative in our case, like this formula doesn't change. So this is the pre-tax wage. Owner pays is the same actually because of constant return, and then the after-tax wage the engineer receive go down by exactly the tau factor tau. So this is accident, but lucky accident. So this policy works beautifully.
But you can also change interest rate in that sense, no?
Here, no, this is a small open economy. Okay, so, yeah, yeah, Bruno.
So if you don't think I'm being foolish, maybe I can try to tell you what I think I understand.
Yeah.
And you will tell me how wrong I am. So I think what I understand is the following. So we have a principal and we have an agent.
Yeah.
And the principal is hiring the agent.
Yeah.
But the problem is the principal needs the agent to continue to operate the project.
Yeah.
So if the agent goes away, let's say the value of the project is only 1/2 of what it could be if the agent stayed.
Yeah.
So the principal hires the agent, and after one period, the agent says, if you don't give me 1/2 of the value, I go.
Yeah.
And so the principal says, okay, well, I have to give him 1/2, and I can only keep 1/2.
Yeah.
Then the following period.
That's only in the first example.
Saki, if you would like to be so kind as to let me speak, that would be lovely. I'm not finished. So then the following period, the agent goes back to the principal. And again says, please give me 1/2. And so now the principal only has 1/4. And it goes on and like that.
That's your intuition is perfect for this example. So basically, every period, engineer keep coming. I want the 1 minus theta fraction, and then next period they come back again. And they cannot pre-commit to provide maintenance service forever. They keep.
And I have two more things to add on this, which is because of that, there is not enough that is left to the owner. And so it reduces the incentives of the owner to invest at the beginning. And that's why we have an underinvestment problem.
So basically, the owner will not pay much because of they have to pay a lot later on. And therefore, engineer cannot invest as much. So engineer is the investing agent as well as the maintenance guy. So, and then this is the investment technology. They put the goods and building to get the plant as well as the tool. And they keep the tool they sell the ownership of the plant. And then the owner knows the engineer keep coming back. And the alternative of engineer keep coming back is this production function. Basically, the productivity is a function of cumulative effort of engineer. And this has the same feature of the engineer keep coming back and asking the eta fraction of the stuff.
And the last thing I wanted to say on this, and maybe again I'm wrong, is why is it that the government can help?
The reason government
I think I know the answer.
Yeah.
It's because when the agent says, give me 1/2, then the principal has to give the agent 1/2. But then the government is taking some of this 1/2.
That's right.
And is using it to subsidize investment.
Yeah. So it is true. So basically the wage rate is going to be, total wage rate is still this one. So coming from production function. But some fraction of wage is intercepted by the government and doesn't go to the engineer. And effectively, engineer is committed to work less than marginal product. That's how things works. Yes.
Thanks a lot. Thanks a lot.
Am I supposed to stop sometime around?
Yeah, I guess it has. We have kind of naturally morphed into the Q&A, so we can keep going with questions for a little while.
Nobu, I'm going to return to what I was saying earlier. That first of all, I thought it was super interesting, and I think you know, I think it's a natural enough contracting friction to think about. But I'm not sure it applies. I'm not sure why you want to think about this as something that applies to the whole macroeconomy. And I thought your illustration of Japan was enlightening along these lines. That, you know, maybe what we think about as the problem in Japan is not so much about an aggregate problem as more an innovation problem, something specific to sectors where this would be an issue. So I guess I would, especially if you want to, you know, you lapse into talking about monetary policy at certain points. If I think the way to do that is, let's talk about this as being a particular sector of the economy where we think this kind of contracting problem is particularly salient. And then I think it's, first of all, more natural, and then I think that sort of the policy questions are become much more interesting.
So low interest rate leads to the temporary boom followed by stagnation. There are a lot of alternative explanation, and Shevnan's misallocation story is the natural one. And this is more about how to finance the intangible investment, intangible capital investment, when the key work was continual effort is essential for maintenance.
Right. No, so if you can show that low or somebody can, you don't need to do it yourself, but if this paper leads people to show that low interest rate policies are particularly problematic for intangible investment heavy sectors, I think that would be interesting.
That's true. So we think, but like a temporary boom followed by the stagnation sounds like a Japan. and we get excited about the net worth going up. So initially, but eventually the denominator starts dominating. And John wants to call this as a denominator. so like a denominator is dominating in the long run. So.
But there's a dimension that where interest rates have an effect on the real option of continuing the capital that is independent of the investment side, and that would be interesting to disentangle as well.
Yeah, we do have a option to stop this guy.
Right, but there's two dimensions, which is one is how big your investment is at time zero and whether that's efficient, there is a friction, not in the first model, but in the second, there is a friction with that, and only then, and after that, everything is efficient in the upper.
Right now it's once it started, it's efficient.
Once it started, it's efficient. So there's an inefficiency at time
zero, investment time.
And there's another dimension, which is how long the life of the plant is. And that of course is a function of the interest rate, because that affects you know, your the net present value of F, but at the same time you have decreasing return, so that's going to shrink the
for example, if alternative use is rather good, so then not every plant survives.
Right.
And some plant keep improving, some plant keep declining before shutting down. So that is equilibrium, actually.
Yes, but then there's one dimension that has to do with only the real option component. Even if you had efficient pricing at time zero and efficient investment at zero, the horizon would be sensitive to R. In the model, you have a second layer. You have a second layer, which is that is also impacting the level of funding, and it would be interesting to unpack both.
So this critical level is a function of R, actually. So it's true.
All right.
I'm going back. I don't want to push much but I think I was not clear what I was trying to say. Is like there is a policy in place in many countries, including the US. We allow you to use your depreciation on your capital to pay less taxes, which is kind of basically a subsidy on investment. So if you ask most people, we already have a subsidy on investment by giving this tax benefit. So you basically, it's kind of like basically what you're saying is like you bring your tax. You depreciate your costs more short term, so you're allowed to depreciate all of your investment in the first few years. So that's what I was asking was, could you look at something like that's already in the code and see the effects of that? Because that's basically making investment cheaper. I don't know how it would work separate from the engineer point of view to the plant owner, because that seems to be more for the plant owner. But it's, the engineer's is making part of the investment, probably he would benefit too.
I
but that's what I said, like, can you look at that particular part of the tax code and see if that would have similar effects?
Our investment depreciation is highly endogenous animal. So therefore you cannot tell that's the particular depreciation rate.
But that's why the tax code is beneficial, because you can you basically can depreciate in the tax codes, not the real depreciation, just for tax advantage.
I see.
It's
so
like
we never
write off the costs all at once, right? Like, but you can write off in 3 years when the capital didn't depreciate in 3 years, right? So it's a tax advantage.
We haven't thought about the money policy to change the tax depreciation rate for tax. So I should. Wait a second. Shenxin is here, so Shenxin can correct my wrong answer. So Shenxin, do you want to say something? Or can you hear? Oh, he cannot. He's not authorized. So.
Is he?
Hello.
Hi, Nobu. Hi, everyone. So,
did I say something wrong?
I don't have anything to add. No, right.
It must be midnight for you, so.
Yeah, it's midnight. Okay.
He's too tired.
All right.
Comments.
Hey.
So,
thank you very much for
framework. I mean, it's a very interesting framework. I mean, I think like everything you do is very interesting. On this one, I think
strange, but
you have to. I mean, my honest friend opinion is that you have to work more on the clarity of the where the friction lies, and I believe there's, although the first example is very clean and neat, it's misleading for the second part of the presentation, because the first example doesn't have marginal pricing, and so the friction in the first example is the lack of
commitment.
Commitment or also a market. But here in the second part, you can have commitment or no commitment. In competitive equilibrium, you don't have commitment to work.
It's a special case. So
say again.
First example is a special case of the second one.
I don't agree, because in the
allocation is the same. So
allocation is the same, but the efficiency is not the same.
Yeah, it's different, but it is the same.
Allocation. I can write two economies, an inefficient economy and an efficient economy. They can have the same allocation, and yet fundamentally.
Yeah, we can talk about that one later. So
yeah, it's two different model. Yeah, and that we agree.
I think
it's a different model.
It's a different model, but it's like the frictions are different, and it's along the path.
Initial example, we never talk about like aggregate investment and that sort of thing.
I know. But you can forecast where it would go if you had a dynamics and an investment, and the fact that you don't have we know this, that when you don't have a labor market and everything is determined by bargaining, it's inefficient. We know this.
So this one, competitive equilibrium, is therefore very close to the constraint efficient. So that's why we thought it's better for aggregate and dynamic analysis. So okay.
All right.
Okay. Thanks a lot, Nobu. That was great.
Thank you.
And thanks a lot also to the panelists who are still around. The others already had to say their goodbyes, but it was great to have all the comments. Let me stop the recording and the official part. If people want to stick around and discuss more, that's fine. But let me just stop the recording.
Yeah, let's stop. So now you can say the wild things without